Okay, so the next topic, new chapter is ESOP, Employee Stock Option Plan. This is going to be your Group 2 subject paper, ESOP, Employee Stock Option Plan. So this is one of the very powerful techniques introduced by the company which I know. The most famous one is Infosys. Yes, ESOP, buyback, banking, NBFC, all these are what we are going to do is in Group 2. So Infosys is the one of the pioneers to introduce this, to encourage the employees. They wanted to make employees are owners. So that's where ESOP concept have been introduced. So there are so many success stories who are part of Infosys, have generated wealth being an employee, but with the help of ESOP plan. As so many employees I know, one of the person with whom I work as, I provide the wealth management consultancy, and he purchased one big house in one of the cities with just the money that he got ESOP from Infosys. Of course, he worked with the company for more than, let's say, 15 years. Anyway, so this is one of the powerful tool available or mechanism adopted by listed companies to encourage employees. Apart from salary, you'll also have ESOP component. Now, what is this ESOP? In simple words, it is the shares given to the employees at a concessional price. So shares will not come free. Employees have to pay, but it will be given at a concessional price. So with that concession, that is like an income for the employee and expense for the employer. And in fact, even in income tax, that will be counted as perquisites, and on that TDS is also deducted. If you know in income tax, or if you have done income from salaries calculations, you would appreciate that. So typically, I will say ESOP, Employee Stock Option Plan. It's basically a mechanism to encourage the employees to contribute better, because you will get the ESOP from the company, you become the owner, so you contribute better. So you're not working for somebody else. Employee will always have that feeling, I'm working for somebody else. To avoid that, this technique have been adopted, Employee Stock Option Plan. But in this context, as far as the accounting is concerned, there are two main elements. Just give me 1 second. Okay. So basically the meaning of ESOP, I can say like this: shares offered to employees, of course, at concessional price, at concession. So a concession is the benefit for employee, expense for employers. And there are two major plans as far as the accounting is concerned. So one is called as, purchase plan. Yes, I'm writing. You're not able to see? Okay, okay. Uh, you're able to see now? Okay, I hope it's visible now. Okay, so ESOP, we have purchase plan. Then ESOP has option plan. Okay, so what is the purchase plan and option plan? Of course, this is mainly from exam point of view. Purchase plan means offered immediately. Offered immediately. And whereas option plan, then they have to satisfy certain conditions. So I would say this is subject to conditions. So accounting also will change differently. What is offered immediately? Okay, now we would like to issue the shares to shareholders. Market price 80 rupees. I'll give you 60 rupees, 20 rupees concession. You take it or you leave it. That is purchase plan. Option plan means you have to fulfill some conditions. Work with us for 5 years. You complete some targets, goals. You have to make, let's say, at least 100 clients should be joined, or you should have this so much of productivity, or make this team to 100. Certain guidelines, certain targets will be there. And that is called as option plan because it will be subject to some conditions. And what is concession is all about? Concession is the difference between the market price and offered price. So the offered price is called as, exercise price. And whatever is the market price. For example, if the market price is, okay, so it's difference actually, sorry. It is market price minus exercise price. Market price of the share. Suppose market price of Infosys is now trading at 1,500 rupees market price, but the employees are given option. You can buy at 1,400 rupees, 100 rupee discount. That what price the company, at what price the employee should pay to get this share is called as exercise price. So 1,500 rupees the market price, but employees can buy at 1,400. The difference 100 is called as intrinsic value. Sometimes it's also called as fair value of the option. So there is a mechanism to which we calculate the value of option. Having the right, we calculate the value of the right. That you will come at a later stage. Don't worry at this point in time. So shares offered at concession, market price minus exercise price. The intrinsic value, and this is the income for employee. And whereas this same intrinsic value is the expense for employer. Of course, in our calculations, we will focus on this. Accounting we will do in the books of company, So we are focusing on this. But in the income tax, when you calculate income from salary, you will focus on income from employee as a perquisites and all. But now in our accounting, we are focusing on the employer books of accounts as an expense, the concession given. We don't have an accounting standard. We have a guidance note, but does not matter. We will do the process according to the logical sequence. To write down this much, we have to read some more terminology like grant date, vesting date, excise date and all. We'll come to it. First, to write down up to this stage. And if you have any doubts, please ask. And one more small point. Now this is offered immediately. So the expense, what we just discussed, is recognized immediately. What is that expense? Benefit for employee, expense for employer, the concession, intrinsic value. The expense recognized immediately. Whereas in option plan, because it is subject to conditions, so conditions to be fulfilled, so it is not going to be immediate, it is going to be over a period of time. How exactly over a period? I'll come to it. For the time being, I will write expense recognized over a period of time. So employee stock option plan, shares offered at a concession to make employees more powerful, to attract talent by making them owners. Two plans as far as accounting is concerned. Purchase plan, immediate offer is given, you accept or you don't take it, expense recognized immediately. Option plan, it is subject to fulfillment of some conditions, so expense not recognized immediately, it is recognized over a period of time. So option plan we should discuss a little bit more in detail. We'll do that. Please write down till here. See if all these terms and discussion so far what we had is clear. Intrinsic value of the option is the difference between market price and excise price. If the info share price is 1500, but the management is giving the employees at 1400, you are given a concession of 100 rupees. That concession is called as intrinsic value. Sometimes it's also referred as fair value of option. But what is options, futures, derivatives and all, you will understand later at a final level. At this point in time, don't worry about it. Just understand the concession is called as intrinsic value, sometimes also referred as fair value of option. Okay, so done till here. Yes, okay. Now I'll quickly discuss about this purchase plan, because you know it is a straightforward thing, does not require much of calculations, no tabulation required, so we can finish our discussion here itself. But option plan I will discuss in the separate slide. Now let's understand straight away with the help of journal entry, because easy for you to take it as well. So journal entry. Okay, first of all, these are share issued and you are getting a money at exercise price. You are getting the money. So what account should be debited? Bank account debit. Money is coming in. That is at exercise price. And then you are giving them concession, intrinsic value. So it is like an expense for the employer. I have written this expense for employer. So I will call it as employee compensation expense, or you can say employee benefit expense. Employee compensation expense, or you can say employee benefit expense. This will be at intrinsic value. Then 2, when you issue shares, it will go to share capital. So 2 equity share capital. Which is face value. And balancing figure, we will take it to security premium. To security premium. Premium portion. That's all, nothing else. Premium. But one important point you have to understand is this entry you pass only if it is accepted by the shareholders. We have given the plan, purchase plan. We have offered 1,000 employees. Only 990 employees have accepted. Only for them, I will pass this. So only for those who accept the offer. This is only for those who accept the offer. If they don't accept, we don't even consider them in any of the calculations in purchase plan. So suppose the market price is, you see, 1,500. You have given them at 1,400. So bank account, you will write 1,400. Money coming in. Concession, you write 100 rupees. Suppose face value is 10 rupees. Remaining 1,500 minus 10, 1,490 will be transferred to security premium. So bank account debit, exercise price, employee compensation expense account debit, intrinsic value, the concession, to share capital, face value, to security premium, the balancing figure, nothing but exercise price plus intrinsic value minus face value. That is going to be your premium amount. So write down this one, the journal entry under purchase plan, then I'll go to option plan. Is this completed? Shall I go to option plan, where we have to understand some more terminologies? Okay. Okay, now let's go to option plan. Here certain terminologies are required. One is called as grant date. Now, the meaning of grant date is it is a date on which announcement is made. Date on which announcement is made. That is a grant date, starting date you can say. Then there is one date called as vesting dates. Now the date on which the conditions are fulfilled. I told you example, right? Suppose employee should work for 5 years. That is the date on which the condition is fulfilled. Date on which condition is fulfilled. Satisfied. And this period is actually called as vesting periods. So from the grant dates to the vesting dates, this is called as vesting period, where the condition is satisfied, condition is fulfilled. From the vesting date till the vesting date means you fulfill the conditions. Employee should work for 5 years. Okay, you have completed 5 years. Now you are eligible. From this date, eligibility starts. But is it compulsory for them to acquire shares? They have a choice. So they will have a time to decide, and that is called as exercise date. Exercise date. So this is the date on which the eligible employees, vested options people, they will take a decision. This is the date on which exercise decision is made by eligible employees. Decision is made by eligible employees. And this period is called as exercise period. Exercise period. Like they will have time to decide 6 months, 8 months, 1 year, whether they want to subscribe or they want to give up. They have a choice. That is called as exercise period. Now, this is an interesting situation. Observe here. This vesting period may run up to, let's say, 5 years. Only when employee completes 5 years, he will be eligible to get the shares at a concessional price. Now, please tell me, according to matching concept, accrual concept, should I wait for 5 years to recognize that expense? Or should it be recognized over a period of 5 years? Conceptually, you are getting the point. Employee is subscribing to the share, which is a concession expense for the employer. That will be known only at the end of 5th year, assuming 5 years is the vesting period. So should I wait for 5 years to complete, then recognize the expense? Or should I recognize over a period of 5 years? Now, if I wait for 5 years, don't you think employee worked for 5 years and you recognize at one shot? Do you think that is accrual concept, matching concept? The benefit for the employee is accruing over a period of 5 years, right? Employee, to get the eligibility, has to work for 5 years. So the benefit should be spread across. That is accrual concepts. I know your concern. Sir, what if employee leaves? I'll come to that point later. For the time being, you assume employee will be there till the end of 5th year. Assume that. So conceptually, expense to be recognized on accrual basis. So the concession what we're talking about is spread across this period. It accrues every year. See, gratuity, you take an example. It is paid when the employee leaves. But how the benefit accrues? Benefit accrues every year. Not sure whether employee will accept or not. That uncertainty, I'll come to it later. I am talking about accrual concept. If employee should receive, his benefit is accrued over 5 years. That is true or not? Whether employee will accept or not, that is going to be an estimate. Accounting estimate I'll handle later. At this point in time, conceptually, employee will get the benefit only if he works for 5 years. So his benefit is accruing every year that he completes. I hope that is clear. So in the vesting period, the employee compensation expense to be recognized. The expense to be recognized. Employee compensation expense. Expense recognized. And the journal entry for that is employee compensation expense account. Employee compensation expense account debit to ESOP outstanding. This employee compensation expense goes to P&L account, and ESOP outstanding goes to balance sheet, and it will be part of shareholders funds. Now, the issue may be, sir, you are expecting that he will be there for 5 years. What if he leaves during the year? That one uncertainty question comes. One more uncertainty is also there. What is that? He worked for 5 years. He is eligible to get the share. Will he get the share? In the sense, is he compulsory on him to buy the share? He is always a choice. Exercise period is there, right? So, in the exercise period, there are two things possible. Eligible employee accepts or don't accept. So, eligible employees accepts. Then what will happen? Accepting means they will make the payment. So, I will pass an entry, bank account debit. Concession, I will not debit employee compensation expense that is already debited. So what will I debit then? ESOP outstanding account debit. Because I've already transferred to expense. Then to the extent of face value, I will transfer it to equity share capital. And to the balancing figure, I will transfer it to securities premium. Which is whatever the issue price, the exercise price, plus the intrinsic value, minus the face value, that's called a security premium. But for those who don't accept or things lapse, those who don't exercise, options vested but lapsed, for them, whatever ESOP outstanding we have to close it. So I am debiting it and I will transfer it to general reserve. ESOP outstanding, I will transfer it to general reserve. So you write down this journal entry in both the cases. During vesting period, you recognize the expense. During exercise period, you transfer that to share capital. Or if not exercised, it will be lapsed. You will transfer it to general reserve. So take 1 or 2 minutes time, go through all these calculations, see if you have any doubts. Because there is one more segment, I mean, whatever we discussed only, some more issues to be addressed. I'll take it after that. But first, if you have any doubts, get it clarified. Okay, I hope it is completed. Shall I go further? Okay. The recognition of an expense part will have some challenges. So let me address that separately. So recognition of expense during vesting period. Okay, let me take you with the help of an example. Suppose the announcement date, grant date is 1/4/2020. Grant date. And vesting period is, let's say, 5 years. Or let's say 3 years. Vesting period 3 years. Now, can you tell me what is going to be the vesting date then? Three years from 1/4/20 means, can I say 31st of March 2023? 3 years, no, simple calculation. So we will have year end in between 31st March 2021 and we will have year end 31st March 2022. Okay, now you please tell me, please observe this. Number of employees who are on grant date were, let's say, 1,000 employees. And during this year, 100 people have left. So as on 31st March 2021, 900 employees are there. Suppose concession is 20 rupees, intrinsic value. Intrinsic value, 20 rupees is the intrinsic value. So 20 rupees. Now, please focus this. I'll give time to write down. Answer me this question. For how many employees I should consider now to recognize expense? Is it 1,000 employees or 900 employees? As on 31st March 2021, for how many employees I should consider to calculate the expense? Is it 1,000 employees or 900 employees? You understand, it is 900, not 1,000. Why? Because 100 employees have left. They are no longer eligible, right? Definitely for 100 employees, we are not going to calculate any expense as on 31st March 2021. I hope that is very clear. People have left, they're no longer eligible. They can't claim anything. Vesting period 3 years, you're not fulfilled. First year only left, you can't ask anything later. They have left also. But let me tell you one more thing. Out of these 900 employees, do you think all of them will be completing 3-year term? For sure. You're also raising the concern, right? Out of 900 employees, we don't know how many employees will actually complete. There is uncertainty. Getting the point? Out of 1,000 who started, 100 definitely is no more eligible. Remaining 900. But out of 900, in the next 2 years, some more people can leave, right? We don't know. But we cannot say the answer don't know and we cannot stop accounting. What is the alternate available in accounting? We go with accounting estimate. We provide depreciation. I don't know how many years asset is going to be used for. I have to spread across that period. I'll make an estimation of useful life. Similarly, as on 31st of March 2021, I have 900 employees, out of whom we don't know how many will still survive. Okay, make an estimation. My estimation is 10% of the people will leave during the every year. That is my past data. 10% is my labor turnover ratio. Employee churn is 10%. So I'll say 900 employees as on this date. I'll multiply it by 90%. I will multiply it by 90%. Why 90%? 90%? I'm assuming 10% of the people will leave. In the first year, I come to 22. 10 more percent of the people will leave. 23. So my estimation is if 10% people leave, remaining 90% will stay with us. So again 10% will be leaving in the next year. So 90% people will be leaving with us. So whatever number I get, that is the expected number of employees who are likely to complete vesting period. So this is the number of employees likely estimated to complete the vesting period. Now next year, you are supposed to leave 10%. Actually, number of people left was only 3 people. Okay, next year, our estimation changed. Revise it. Change in accounting estimates. Nothing problem. Accounting is done on estimation basis in so many cases, and that is why it's called as true and fair view accounting, not true and correct view. Fairness, we have done the estimation, and based on estimation, you recognize the expense. And one more thing, whatever expense, 900 employees into 20 rupees, assuming one option given to employee, will I recognize everything in 1 year? It is not accrued in 1 year. It is to be spread across 3 years, right? So I'll recognize 1/3 in this year, 1/3 in next year, and 1/3 in next year. And second year, third year, estimation can change. Okay, you apply for change in accounting estimates. But I hope you got this conceptually. Now, considering all these things, I'm going to give one simple tabular format that will help us in solving the problems in a faster manner. But conceptually, get the things right. Recognition of an expense during the vesting period. At the end of each year, you make an estimation. What estimation? How many employees are likely to be there at the end of vesting period? Based on that, you recognize the expense spread across the vesting period. And when estimation changes, you can say the change in accounting estimates. See what example I gave you earlier. For those people who lapse, in the sense options lapsed, option vested but lapsed, we say vested options lapsed. But what about this 1000 at the beginning became 900? This we call it as unvested option lapsed. Getting the difference? Technical words. Vested options means that will come later, who have completed the conditions but not exercised. They are called as vested options but lapsed. Unvested means who left during the year or who are not likely to fulfill the conditions and they have left. That is called as unvested option lapsed. Anyway, not required in any of this calculation. Just told you for your reference. Now, because of this, lot of estimation can change. And in that period, the calculation can be tricky. So I'll give one format. You follow that format. Any changes that can take place, we can calculate in a efficient, timely manner. I'll give you that format. But if you have any doubt on this explanation, get that clarified. Okay, so let me talk about the format now. This is the format of the table I was referring to. This table is required only if there is a change in estimate. If the estimate does not change, this table is also not required. I'll explain this table logically, don't worry. And most of the times at IPCC level, intermediate level, estimation don't change. So you can calculate faster in exams. But for safety purpose, I will talk about change in estimates, how it is to be taken care, because in final level, again these concepts will come back. At that point in time, this table will help you. Okay, let me explain this conceptually. So I'm assuming suppose 3 years as a vesting period. So I'll write year 1, then year 2, then year 3. Don't write this down at this point in time. I want you to understand this table. I'll give you 5 minutes later for you to copy it down. Comfortably you can write. First you understand, because this should not be by-hearted, and this is a format which I have created. So logically you should understand how it is structured. Number of employees expected to satisfy the condition. Are you getting the point? Expected to satisfy the condition. So in my example, 1000 employees are there, 100 people have left. My estimation is 3% of the employees will leave. I'll multiply it by 97%, multiplied by 97%. Why 2 times? I'm at year 1 end. How many employees will leave after year 2? How many employees will leave after year 3? That is my judgment estimation. But when I come to second year, we start with 1000 employees. Maybe 100 have left in the first year, and 50 have left in the second year, and my now estimation is not 97%. My estimation is 5% of the people will leave. So I multiplied by 95%. Last year, no estimation required. I'll say 1000 employees were there, 100 have left in the first year, 50 have left in the second year, maybe 75 have left in the third year. I'll get to know the actual employees who are vested. Then options per employee. Options per employee, each employee might be given 10 options, 100 options, number of shares, every employee, that is options per employee. Intrinsic value per share is difference between exercise price minus the market price. The market price minus exercise price. That is called as the intrinsic value. And total expense in the vesting period is a multiplication of 3. So if I say number of employees is 1, options per employee is 2, and intrinsic value is 3. So total expense will be the number of employees multiplied by options per employee multiplied by the intrinsic value per share. That is, when you multiply, you get the total expense in the whole vesting period. Vesting period maybe let's say 3 years, and I follow this closing balance approach because estimation can change, number of employees can change, options per employee can change. So when things changes, adjusting for those changes will become complicated things. So what I do is I follow closing balance approach. So I see what is the closing balance, I subtract the opening balance, difference is expense for the year. And what is a closing balance? I'll take whatever is the expense in the vesting period, this one, total expense. I multiply it by what is supposed to be my closing balance. See, if my vesting period is 3 years, I've completed 1 year, so my closing balance should be 1 out of 3 years. If vesting period is 7 years and I've completed 2 years, then closing balance will be 2 by 7. Getting the point? How many years completed divided by total vesting period is supposed to be my closing balance. Then subtract opening, balancing figure, current year expense. All the calculations will get adjusted automatically. So closing balance is calculated by this 4, if I may say so. Or I'll just calculate here. Closing balance is calculated by the total expense in the vesting period as calculated in 4th point above, multiplied by number of years completed divided by total vesting period. So this will give us the closing balance, subtract the opening balance, balancing figure, you get the current year expense, and current year closing is next year opening, and goes on for how many years it may be. So this is the employee compensation expense calculation. Employee compensation expense. Estimation. So you can write down this table. Now this table is required only when the estimation changes. If estimation remains same, so much complicated table not required. One calculations only you can do, and many problem in exam will be based on that also. So for the time being, you write down this table. When we solve the problems, you will get more confidence. And this table, do remember, will again come to you at final level. Share-based payment is called as share-based payments. We have discussed consolidation, again comes at final level. We have discussed accounting standards, again comes at final level. All will be as Ind AS level. So basically some more new things will get added. But if your foundation is stronger, new things that added becomes much more comfortable to follow. But anyway, write down this table, focus on the concept, get your doubts clarified, write down. Okay, so is it completed? Okay, I hope you got it. I'll go further.